One thing I just would want to say that actually I'm not going to cover, but it certainly gets a lot of focus is, the world in which we live in with very low interest rates and so this lower for longer regime. That's kind of well covered. It was true post-COVID, so I think that hasn't really changed. I think these three here are probably a little bit less discussed and maybe appreciated, but I think could ultimately have, as an important impact on how we think about asset allocation and investing, in portfolios kind of going forward. So just kind of starting on the first one, this greater economic structural uncertainty, and what does that mean? So I think to give some context, it helps if we go to the next slide, which is very simple. What it tries to show you is this is GDP in the US, actual GDP from 2013 through 2019. And you can see for the most part, it hovered around 2%, from a low of like maybe 1.5 or 1.6 to a high of around 2.7 or 8. This year, it's clearly going to be much lower. We know it's going to be somewhere around probably -4%. But what those three lines show from 2019 onwards is sort of economists' forecast for this year, for 2021 and 2022. And this is just in Bloomberg data. They take economists from different banks and institutions, put it together, come up with an average. That's the middle line. And then what was the high forecast and what is the low forecast? So for 2020, we know it's going to be a deep recession. Most of the year is already kind of baked into it. So I think that's kind of less interesting. What's more interesting is if we look at 2021, the average forecast is around 3.7%. There's a pretty wide range from a low of like around 1.5% to a high of almost 7.5%. And then if we go to 2022, the range is still as wide. The average is a little bit lower. And I think that's really kind of noteworthy to me that if we had a decade prior to this where growth was hovering very closely around 2%, these are like kind of the sharpest minds about forecasters on Wall Street, and the range of outcomes just for next year is over 5 percentage points. So that's a huge difference in a period environment where we know we're going to recover, but there's just a wide range of outcomes. And as we go forward, I think the range doesn't diminish at all. And it's sort of understandable why there's this kind of wide range. We don't know right now what sort of fiscal stimulus we're going to get, either before the election, which looks unlikely, or after the election, and what the outcome could be from that. We know that the economy could slow a little bit because there hasn't been fiscal stimulus. So some of the maybe kind of scarring to the economy from people staying laid off or unemployed for longer, businesses that have survived until now, maybe they start to go bankrupt. So there could be a longer road to recovery. The pandemic is changing consumer behavior. So certain industries, travel, leisure, tourism, have all been significantly impacted. If that doesn't come back, then you have to have a reallocation of resources, both capital and labor, to different parts of the economy, and that takes time. So you kind of go through these different factors and you realize there's a lot of uncertainty of how we're going to grow from here, how fast, and also the range of outcomes. And when you have kind of greater range of outcomes, sort of greater economic uncertainty, that really means you also have fatter tails. These are really kind of extreme outcomes. And when you have more economic dispersion or fatter tails, you can have more economic volatility. And more economic volatility translates into more market volatility. And that impacts the performance of equities, fixed income, other risk asset classes. So if we go to the next slide, I think one of the implications of that is not just higher volatility, but higher volatility of volatility. What the chart is showing, and it goes back from, you can't quite see the horizontal axis, but it goes from about 2005 until this year. And this is the VVIX index. It's the volatility of the VIX index. In general, it's been sort of trending higher from 2005, kind of gradually higher, but this year it's accelerated even more. To levels that now we're seeing when markets move and volatility jumps, it jumps a great deal. I think this reflects the fact that in a world where economic tails are fatter, you're going to get bigger and fatter tails for the markets, and that leads to higher volatility. And as an investor, that means you have to be prepared for sort of bigger moves. When things sell off, they tend to sell off together. So diversification becomes a little bit harder. But it also means things that the owning exposure through sort of non-linear options as opposed to kind of linear exposure to markets is important, because you get more convex outcomes. When things move, they move a whole lot. So you want to kind of capture the upside or the downside. So having exposure in your portfolio to kind of that optionality becomes more important. If we just think about what's happened in the past 2 weeks in the markets with the kind of the tech sell-off, I think a lot was made of how certain investors, both retail, but also a few big institutions, were using options, call options, to get exposure to tech stocks. When they were unwinding, that led to some sell-off in the tech space 2 weeks ago. That kind of general idea of where investors are using option markets in a high volatility market kind of apply more broadly to the markets. I think that's something we're going to see certainly persist, but kind of be a more kind of structural theme kind of going forward. And this is something as an asset allocator we have to think about. So that's one implication of this post-COVID world. The second implication is the consequence of inflation becoming more important. We can kind of get a context why on the next slide. And this shows two things: the long-term treasury yield. So basically think of like the 10-year treasury yield and the earnings yield on the S&P 500. And the earnings yield on the S&P 500 is just the inverse of the PE multiple. So higher PE multiple, a lower earnings yield. What the chart shows, and again, the x-axis is not showing the dates properly, but it goes from basically 1950 until the current time period. So about a 70-year history. And what we see is from a period of starting around the late 1960s, and that's kind of where the first vertical dashed line materializes. You saw both interest rates rise and then also the earnings yield decline, or you could think about equity valuations, the multiple declining. They rose through the 70s and sort of both peaked in the early 1980s. And then they began a 20-year period where interest rates declined and then the earnings yield declined, or the equity valuation, the multiple increased. Now, where the dashed vertical line should appear is probably somewhere, around where if you could take the bottom of the 10-year or the equity multiple, which is the light brown line. So if we think of that sort of 30-year period from roughly 1970 to 2000, that's what I would call the inflation factor regime. Starting in the late 60s, inflation rose. It rose in the 70s. That was the stagflation period. Peaked in the early 80s. That's when Paul Volcker came in as the Fed chair, raised rates, induced a recession, to finally kind of get rid of inflation. And then we went on a 20-year period where inflation was falling. Finally, by 2000, it was tame, under control, and inflation became sort of a secondary issue to growth. So really, during that 30-year time period, it's inflation more than growth that was driving the markets. And if I had an inflation line on here, you'd see the same kind of pattern. Now, this matters because then if you go to the next slide, what it shows is the correlation between stocks and bonds kind of over a similar time period. And this is just sort of a rolling 5-year correlation of the returns to essentially US equities and think of like kind of a 10-year or longer duration bond. And you can't, again, the timeline is not showing up properly, but basically the correlation turned positive in the mid to late 60s, like around 67, 68, and it went negative around 2000. So that big chunk of time period when the correlation is positive, that's that inflation regime. Since 2000, we've been in this environment where the correlation is negative. Inflation has been tame. This has been an ideal environment for kind of simple 60-40 portfolios because stocks and bonds have been negatively correlated. Returns for both have been great. It's been a really easy in some ways an asset allocator just by having that simple diversification. If we go back to something that's a little bit higher inflation, and with the Fed now announcing a policy shift towards average inflation targeting, it's possible that inflation could certainly get above 2%. This is not a forecast for inflation getting there in the near term. I think it's at least a couple of years away. But if we go in that direction and the Fed allows a little bit higher inflation, and sort of policymakers in general want it because that helps us deal with the debt problem of higher inflation. Inflation, which has been tame for 20 years, could become a more relevant factor driving the financial markets. And if that's the case, then we could go back to a version of this inflation regime from 70 to 2000, where it drove asset prices. And if that's the case, then this negative correlation between stocks and bonds could become positive again, or at least less negative, which certainly kind of complicates overall kind of diversification. Not only do bonds have low yields, but they're not even giving you that diversification that they have for 20 years versus equities. So that's one kind of implication, a complication from this maybe different post-COVID world. And the third and final one is a little bit more optimistic. It's on global diversification. We can see it on the next slide. As someone who does asset allocation, we constantly tell people to have a globally diversified portfolio, allocate globally. That way you get good diversification. What these lines show is the correlation of international developed equities, that's the dark brown line, and EM equities, that's the light line, to the S&P 500. And the lines start from around 1990 and they go up to the current time period. So if you go back to the early 1990s, the correlation both basically international equities to US equities was 0.5 or lower for much of the decade up until like maybe 97, 98. Which really kind of feeds into this idea like this is good for diversification when the US is doing well, other regions maybe aren't, and vice versa. But from about 2000 onward, and certainly since the post-financial crisis, the correlation for developed markets to the US equities is around 0.8 for the most part. EM has been a little bit lower. It's definitely had some periods where it's been lower, but it's also kind of been a lot of times around 0.8, which means that you can diversify globally, but you're not really getting that much diversification because equity markets have become increasingly correlated. So globalization has had certainly many benefits. It's had some negatives. But from a market perspective, it's actually made equity markets a little bit less diversified. Things kind of move more closely together. But now we're in the prospect of facing some deglobalization for different reasons. One was because of the US-China trade tensions that began prior to the pandemic. And that's likely to continue, not just on trade matters, but on technology, on capital, on geopolitical security matters. And now with the pandemic, I think the idea of having global supply chains that are tightly integrated, we can see the vulnerabilities of that. So you're likely to see some deglobalization or regionalization. So one scenario of all this could play out is that we can end up having almost a two-pole world, where there's one that's sort of led by the US on a technology front and another led by China. So ironically, as the US and China sort of decouple in different ways, from a global asset allocation perspective, this actually makes China more attractive because how it performs could be very different and for different reasons than how the US market performs. So the correlations that have been rising in equity markets could actually decline going forward. And if you go to the next and sort of final slide, I think it's sort of important to think about that in terms of an investing perspective. What this line shows is the relative performance of EM equities versus US equities since 1998. Now, if you're an asset allocator, and I know I've heard this from our clients, that they've complained about the international equities, why do we allocate to them? US has clearly outperformed for at least 6 or 7 years. And what the line shows is that anytime the line is going down, that means international equities, in this case, EM, is underperforming the US. And really, it's been since around 2012, 13 that EM has underperformed. But what's noticeable about the chart is that there's basically been sort of 4 regimes since around 1998 or 1988, where either one region or the other has clearly outperformed. From late 80s to mid 90s, from that was EM outperforming, 97, 98 into the early 2000s, that was the US. Then you had the BRIC sort of, era from the early 2000s to the financial crisis, and really for now the past 6 or 7 years, the US. So this would suggest, and maybe kind of, the global conditions are lining up for EM to outperform. We think about this as a time when you actually want global diversification, not just be in the US, because of these macro trends coupled with this outperformance. This is certainly a time when you may have capitulated on sort of global diversification, but it's kind of more important than ever. So I just wanted to give a little bit of a flavor of how I think about it and sort of what I'm thinking in terms of constructing portfolios, thinking about asset allocation as we kind of deal with this post-COVID world. That it's not just obviously about the near term, but these are some of the sort of big structural trends that could take place and how it impacts how we have to think about creating portfolios, how we think about diversifying. And it's important to be sort of proactive as opposed to reactive, because these things will move and then things, developments can happen, and you don't want to be reactive to it and sort of respond as markets already move. So that's my comments, Mark. I'm going to stop it there and pass it back to you.
That's great. Thank you. As you can see, you'll see why Stephen Burke doesn't let me do the slides. I should have used your PowerPoint version. Does anyone want to ask any questions here before we move on to Stephen? Well, it's fresh in your minds. Or we'll continue on and then we'll have questions at the end. So Stephen, while I do have your slides, I think you'd like to run it for a reason. So I'll stop sharing.